This is Mark Sobel. I'm the U.S. Chair of OMFIF. Today, I'm joined by my colleague, Denai Kyriakopoulou, OMFIF's Chief Economist, Research Director, and Chair of the OMFIF Sustainable Policy Institute. And together, we have the great pleasure and honor of hosting Kevin Stiroh. Kevin is the chair of the Federal Reserve's new Supervision Climate Committee, a multidisciplinary committee designed to develop a supervisory approach to increase the resilience of supervised institutions to climate-related financial risks. He is also the co-chair of the Basel Committee's Task Force on Climate-Related Financial Risks. And before that, Kevin was one of America's foremost supervisors heading the supervision group at the New York Fed. And he's even written extensively about productivity and innovation. So thank you for joining us today, Kevin. Denai and I are looking forward for roughly the first half of our discussion to asking you about the role of climate finance and supervision, your new role at the Fed board, and your vision for it. And then we'll turn to Q&A from the audience, which can be submitted via the chat function. So let's dig in. Kevin, can I give you the floor for any opening remarks you'd like to make before we turn to questions?
Great. Well, thanks, Mark, and thanks to it's a pleasure to be here today. Before we jump in, I'll just give a little background on the work that we're doing on the financial risks of climate change. So this is clearly a topic of considerable importance from the perspective of the financial industry. Governor Brainerd of the Federal Reserve Board spoke on these topics over the last few months about the role that financial institutions can play in tackling the risks of climate change. And she outlined both microprudential and macroprudential perspectives. As you all know, the international community is very focused on this topic, and large firms are making substantial investments from both a risk management and a strategic perspective. So just to step back to frame some of our upcoming conversation, as a supervisor, our primary goal is to ensure that the firms we supervise operate in a safe and sound manner, and that they can manage all the risks that they face. And the core of this effective risk management includes measuring traditional banking risks like credit, market operational risks, risk identification, risk mitigation. And these risks can materialize from a range of different shocks: a recession, a geopolitical event, a bad actor, and climate change. And our goal as supervisors is to ensure that firms are resilient to all of these risks. So as you mentioned, the Fed has recently established a system-wide supervision climate committee with a goal to ensure that firms are resilient to climate-related financial risks. We're in very early stages of this work, doing analytical work, doing public engagement, what's necessary to build our understanding so that we can have a robust, analytically sound framework as we approach the supervisory questions. Of course, any changes to the supervisory program, should we make those, would be appropriately tailored across institutions to their size, complexity, and geographical differences. But to be really clear up front, we don't have any views at this point about whether additional supervisory or regulatory actions might be appropriate. As I mentioned, a big part, I think, of our program, of our agenda right now, is engagement and collaboration between the private sector and the public sector. That will push everyone forward in terms of our understanding of these very significant financial risks. So conversations like this are an important component to that engagement with the financial industry. So look forward to the dialogue going forward.
Thank you for that. We're truly delighted to have you today, and that's a great opening to segue into our questions. I'll start off. So in reading the literature and reviewing speeches, there's much focus on climate finance transition and physical risks. So what trends are you seeing in how banks manage climate-related financial risks? And do banks have the right tools and processes in place to manage them?
So as I mentioned, as you point out, we've been doing a lot of engagement with the industry. That's an important part of our agenda for the Supervision Climate Committee. So we've talked to large banks, both in the US and through the work that's been done by the Basel Committee's Task Force on Climate-Related Financial Risks. And there are some themes that have have emerged over those discussions. So one is that firms are clearly focused on this topic, both from a risk management perspective, but also a strategic perspective, thinking about the opportunities to work with new and existing clients. And this focus reflects pressure from a number of sources. Firms are thinking about the business opportunities. They're thinking about investor demands. They're thinking about what their clients need. They're being responsive to their employees. Second point, and this came through loud and clear in some of our discussions through the Basel Committee's task force, most firms are viewing climate change as a cross-cutting risk driver. So not necessarily a new risk that needs to be managed, but as a driver of traditional banking risks, credit, market operational risk, et cetera. And I think that's an important point because it suggests that the existing risk management framework is largely fit for purpose. And now the question is, how do you incorporate the unique characteristics of climate-related financial risks into the existing risk management frameworks? We've seen active preparation, firms thinking about material risk inventories, risk frameworks, doing analytical work to try to quantify the exposures to both physical and transition risks. And that is common across firms, although there is some variation in focus depending on business model and geography. Firms that have large concentrations of certain mortgage exposures, for example, might be focused to a greater extent on physical risk than transition risk. And I'll just emphasize that what we've done is engaging with the largest firms at this point. We haven't done outreach with smaller firms, and we don't plan to do that at this point.
Great, thank you, Kevin, and welcome also from me. It's great to have you here with us today. So you've spoken about banks, and it's actually really interesting to hear about your view on integrating climate risk into existing risk frameworks. I think a lot of institutions in the financial sector are grappling with that question, whether we need new models or not. But in your opening remarks, you also spoke about the role of supervisors, and of course, you're co-chairing also the Basel Committee's task force that you referred to, and you just published a report about measuring and identifying risks. So how do you see also the role of supervisors in terms of looking at the resilience of the financial system in the face of climate risk?
So I think it's important to go back to the purpose and mandate of supervision, and our job is to ensure that the banks we supervise operate in a safe and sound manner, that they manage all risks, and that they remain resilient to the risks that they face so that they can continue to provide the critical financial services that the financial system offers. So with that mandate in mind, it's important to be clear that the question of climate change itself, while an important issue, is not part of our supervisory mandate. That is not part of our direct mandate. We focus on climate change to the extent it impacts the safety and soundness of the firms that we supervise. So we're working with our colleagues domestically and around the world to build our understanding about these issues and to think about where there might be gaps in our supervisory framework. As you know, banks have existing enterprise risk management frameworks, and they're thinking about where there might be new challenges, differences related to the financial risks of climate change that will cause them to need to make enhancements, adjustments, or changes to the risk management framework. And then our jobs as supervisors will go in to assess that. And we're going to move carefully on this question. We're going to continue to engage with the industry to make sure that we have a full understanding and appreciation of the issues. But as I said, at this point, we don't have a view about whether or not there are changes that might be needed from a supervisory perspective. We're still in the capacity building stage.
Well, thank you for that. In your opening remarks and in those comments, you have alluded to the Supervision Climate Committee. Maybe you could drill down a little bit and tell us about what are your primary goals for the committee in the first 12 months, And if you don't mind my asking, climate issues can touch financial stability more broadly than just from a supervisory standpoint. You mentioned Lael Brainerd, my former boss at the Treasury. I think in one of her recent speeches, she mentioned also that the Fed has recently created a financial stability climate committee. Can you clarify what the roles of the two committee are and how they relate to one another as well?
Sure. So when we think about our Supervision Climate Committee, we put this together as a group of senior folks from around the Federal Reserve System to bring multiple perspectives to the questions around the microprudential risks from climate change. We think it's important that we bring in a range of views. I think anytime you have a complex problem with inherent uncertainty, you can come up with more robust conclusions and insights when you take a multifaceted perspective. So we have folks from around the Federal Reserve System, from different geographies, folks who have training as attorneys, as economists, as financial supervisors, and we can bring all those perspectives to bear. And we're trying to do this in a very rigorous analytical way, first building a positive analytical foundation, a really strong understanding of what the issues are. And we're doing that by investing in data, by investing in analysis, to better understand the different transmission channels, for example. This was, as was mentioned, one of the subjects of the Basel Committee Task Force report that was released yesterday, a deeper dive into some of these transmission channels. We're engaging with the industry to understand how they're thinking about climate change. And all of that will build a foundation. And only then can we turn to this question of a more normative perspective on what an appropriate policy response, if any, might be at that point. So that's the Supervision Climate Committee. And we talked about this in the Supervision and Regulation Report, some of these risks that was published last fall. From the financial stability side, as you mentioned, Governor Brainerd talked about the Financial Stability Climate Committee, which is thinking about the same risk drivers, but from a macroprudential lens, thinking about the potential impact on the financial stability of the sector as a whole, rather than individual institutions. That work, as was described last fall in the Fed's Financial Stability Report, and talked about the broad framework that is used around financial stability work, including vulnerabilities within the system and the role that climate change might play as an amplifier as some of those vulnerabilities. Things like greater opacity, maybe incomplete markets that might have a way to amplify shocks through the vulnerabilities in the system. So our colleagues in the financial stability side are going through a similar process, building understanding, thinking about the framework, and only then would they come to the question of whether or not there are steps to a path forward. We're working very closely with those colleagues. There are some areas where there's clear overlap. Data and modeling would be one obvious example where building capacity in that space will be to the benefit from both a microprudential and a macroprudential perspective.
Thank you. And I was wondering if you could elaborate a little bit more on that, because so far we've spoken more on the microprudential side and the supervisory agenda of the Supervision Climate Committee, but how does this supervisory approach also fit in the broader work that the Fed is doing on climate policies and also across all of its mandates?
So I think the mandate is really the key point there. From our perspective, we think about the role or the impact that a changing climate might have on the full range of Fed mandates. My focus is on our supervisory mandate around the safety and soundness of institutions. The Financial Stability Climate Committee's focus is around the impact of changing climate through various transmission channels to the financial stability of the US economy. And that is clearly within the Fed's existing mandate. So it's in no way a new mandate, but it's a new set of shocks that could impact how we think about that. And the reason I think that mandate is so important is there is variation across different jurisdictions, and colleagues in other countries, supervisory authorities or central banks in some cases have a broader mandate than we do. And we're staying very focused on our safety and soundness and the risk management perspective for how we should think about the impact of climate change on financial institutions.
Well, thank you for that. Some other supervisors, like the Bank of England and the ECB, are conducting climate scenario exercises to explore the resilience of the financial system and in individual firms to climate risks. Is the Fed considering conducting scenario analysis as well? And often one reads about climate finance stress tests. How do these relate to scenario analysis?
Yeah, so I think that's an important point. And we talked a little bit about this in the Basel Committee, the task force report that was released yesterday. So the way I think about it, scenario analysis is a tool that can be used for what if exercises to try to think through how a set of shocks, either climate related or technology or policy, the reactions of investors, of firms, of consumers, how that could play out across different scenarios based on different assumptions and impact individual firms or impact the financial system as a whole. I think it's important to distinguish scenario analysis from stress testing. In my view, scenario analysis is a complementary but distinct tool from the stress testing work that we already do. So, for example, in the US, our stress tests are relatively short time horizon, measured in quarters, very quantitative, assessing the impact of well-established shocks that then permeate through banks' balance sheets and income statements and have implications for capital adequacy of individual firms. By contrast, scenario analysis typically is longer term, more focused on business strategy and the viability of firms over a range of uncertain scenarios, and more qualitative in nature. So those are distinct tools. Each could be very valuable. And as you point out, some other jurisdictions have made major steps in those areas. But for right now, we have not made any decision about whether or not the Fed would pursue scenario analysis as a complementary tool to our existing stress tests. I think it's fair to say that we're all in early stages of this work. Much of the international work is described as exploratory or pilot exercises, and that seems exactly appropriate to me. This is very new area. It is enormously complex in terms of things like tipping points, nonlinearities, uncertainty, feedback effects. It's also really complicated from an implementation perspective. When you think about the data needs, the modeling needs, how you put these pieces together in a unified governance structure. So all of that takes time to build. But there's been enormous progress. I think the work that the NGFS has done has been path-breaking to bring this approach more into the mainstream, to lay out tools, to lay out scenarios that could be used going forward. And we're focusing on how we build our capacity to assess those tools, and then we'll think about what might be best suited from a policy perspective when we move a little bit farther down the path.
Crucial to the stress testing and scenario analysis, but more broadly in integrating climate risk. And the NGFS has done great work on that. They've also set up a work stream looking at bridging the data gaps that the ECB and the IMF are co-chairing. There are obvious challenges with data about quality in terms of integrating them in the models etc. How is the Fed thinking about those challenges, and how are you also considering your role as a lead in terms of leadership in supporting also the financial sector and the industry in making progress with the data challenges?
Yeah, so this is clearly just a foundational issue around our ability to assess, measure, evaluate climate-related financial risks. We see this internally when we're thinking about our own work, and it's one of the most common themes that we hear when we talk to the financial industry. The roundtables that we hosted last year as part of the Basel Committee work, our own internal, our own engagement in the US, this question about the granularity and breadth of data that is required to accurately assess, particularly the physical risks, it's just enormous. Just as one by now common example, it's clear climate change is a global phenomenon, but the actual manifestation will have enormous heterogeneity across jurisdictions. It needs to be assessed locally with different data than was typically used, say, for credit analysis. There's a growing focus within the industry and realization about the need for geospatial data that puts precise locations on assets. I think it's no longer enough to know where a company is headquartered. You really need to know the physical location of all the primary assets. And this is something that comes up again and again in our conversations, and there's work that's being done to develop that data and make it useful. But that type of granular data right now is limited. It takes significant resources to acquire and to process. So I think that's part of where the industry and the official sector are building capacity. Maybe a related point, moving from the data to what you do with the data around the modeling question. Models are very complicated in this space for a couple of reasons. One is that historical relationships might not hold in a world where the severity or frequency of physical shocks, for example, might be different than it's been in the past. A second reason would be the types of transition that some are projecting could lead to fundamentally different industrial organizations for economies as certain sectors grow and other sectors contract. So that's a complex thing to model. And then just the uncertainty around the timing, the severity, how the shocks might play out over time. So all of that suggests that trusted models that are trained on historical data might prove to be poor guides for what happens in the future. So that's part of the uncertainty. We talked about this in some of the Basel work about uncertainty basically across every chain of the links from how emissions might impact the climate, how climate impacts might manifest in ways that then have economic or financial sector effects, how those economic and financial sector effects might translate to the balance sheet or income statement or the business model of the firms that we supervise. So there's model uncertainty and parameter uncertainty, there's data quality issues. All of that adds to the challenge that we face.
A tall order for you. And to add to the complexity, so in the US and internationally, there are just many, many regulators. And then there are standard setting bodies on top of that. Certainly in my experience in the wake of the global financial crisis and through the G20, we stepped up the role of the Financial Stability Board as a loose coordinator of the international financial regulatory agenda. There are a ton of bodies now working on climate related issues. How do you plan to coordinate across the many efforts underway both internationally and domestically so that everybody is rowing in the same direction?
Yeah, so you're quite right that there's a large number of interested participants on this topic and the coordination challenge is one that's clearly there. Speaking, for example, from my perspective, with the task force on climate-related financial risks, we've had active engagement with other international authorities like the FSB or the NGFS. We're working closely with all the participating members of that committee. So I think forums like that are really important to ensure that information is being transferred, that we're all leveraging the best practices that are out there. And I expect that to continue going forward. From the Fed perspective, we're involved in all of these international efforts. As you mentioned, I'm the co-chair of the Basel Task Force. We're engaged with the work through the Financial Stability Board. The Fed recently became a member of the NGFS, and we're actively participating in that work. So all of that engagement is happening through multilateral fora, and at the same time, we're talking on a bilateral basis with colleagues domestically and internationally to ensure that we're sharing these best practices and are aware of what's going on. One other point that we hear quite a bit from the financial industry is the importance of consistent standards and harmonization in terms of what policy steps might be taken in the future. So we'll continue to work with our international colleagues as we go through the plan to identify and implement any potential changes to frameworks in the future. And then finally, on the same topic, it's always important to keep in mind the different mandates and the remits that different authorities have. And that's part of the ongoing conversation to ensure that there's a broad range of tools that each authority can use in a way that is best suited to their particular mandate or remit.
Thank you. And a final question from us before we move to the audience Q&A. And you referred a few times to the Basel Task Force on Climate-Related Risks, which you co-chair with the ECB's Frank Elderson, and you've just published the reports. What is on the work agenda? What's coming next in the work of the task force?
Yeah. So as I'm sure you all know, last year the Basel Committee noted that climate change can have both physical and transition risks that are relevant for individual institutions and for financial stability as a whole. And the committee then established this task force on climate-related financial risks last February. So Frank and I have been co-chairing this for a little bit more than a year now, and we tried to proceed in a very gradual and sequential way, building capacity first, and then moving towards questions of policy. So last year we put out a stock take of what different member agencies had done in the space, in the supervisory space related to the financial risks of climate change. And then we turned to some analytical work to try to build a stronger foundation for our understanding. One report that came out yesterday was around transmission channels, to try to really map out those linkages I mentioned before, going from the changing climate to impacts on the economy and the financial sector to the risks on bank balance sheets. And then the second report on measurement methodologies looked at the tools that were being used both within the private sector and in the official sector. Many of the same themes in those reports are the ones we've already discussed around uncertainty, the complexity, the long time horizon, data and modeling challenges. So now building off of that analytical foundation, the next step is to think about whether there are any gaps in the Basel framework related to the financial risks of climate change. And we'll do an assessment, a gap analysis of that spans all three pillars of the Basel framework, including regulation, supervision, and the disclosure elements for the banking system in general. Again, just to be really clear, we don't have views yet on what those what that gap analysis might be. We're going to have to do the work, and we'll see where the assessments take us. we have no preconceived notions about what the outcomes might be. That will depend on the work that's done going forward.
Great, thank you very much. We'll now move to questions from the audience, and there's quite a lot, so let's see how much we go through, and be great to get through a lot of them. So one is about disclosures, and you've spoken about the microprudential side and the guidance to individual firms that you supervise. So the question is the Fed considering any regulatory guidance or requirements for individual banks to disclose their climate-related factors in alignment with existing initiatives, for example, the TCFD, SASB, et cetera, and other disclosure frameworks? At the moment, a lot of these are voluntary. If not, is the Fed considering a separate internally developed disclosure framework that would be tied to existing regulatory reporting requirements, such as, for example, your call reports?
So in the US, the SEC has primary authority over disclosure from an investor perspective. So I would suggest that folks look at some of the steps that the SEC is working through to think about what might be most appropriate from a disclosure perspective on the financial risks of climate change. In terms of the Basel Task Force, we're going to continue to do our gap analysis, looking at all three pillars of the Basel framework. As you point out, the TCFD has emerged as a very common framework for firms to think about their disclosure. One of the challenges that we hear from institutions around disclosure issues is the lack of comparable, sufficiently granular, and consistently defined information about clients that would allow financial firms to make the disclosures that they'd like to make going forward. So I think that's an open question going forward, particularly when it comes to smaller, non-publicly traded clients of the financial firms.
Great, thank you. And just delving a little bit deeper on the regulatory framework in the particular US context. In the US regulatory framework, you have multiple agencies, both federal and state regulators. How do you expect this issue to be dealt with in the federal, state level, both levels? What would be the benefits, in your view, of a centralized federal regulation as opposed to state regulation with regards to climate risk?
So from a bank regulatory perspective, there are a number of players in this. At the federal level, we're actively discussing these issues with our colleagues at other federal banking agencies. We've also engaged with a number of state banking regulators, some of whom have put out already supervisory guidance and expectations for the risk management perspective on the financial risks of climate change. So we'll continue to engage. I think that's an important part of our early stages of the Supervision Climate Committee. We'll be able to learn what other agencies are doing. We'll be able to share best practices and come up with the best set of any policy changes should we make those going forward.
Great, thank you. And then thinking also about the macroprudential or prudential policies and the green supporting factors or brown penalizing factors for loans, there is a question that your global peers, such as the Bank of England, the ECB, are this year explicitly incorporating climate stresses and scenarios in their biannual and annual bank stress tests. Do you foresee a scenario in future where climate risks have an explicit capital add-on, similar to what you see across loan books, depending on the assessed risk of the underlying exposure?
So it's much too early to have a view on what the appropriate prudential treatment might be. But I do think it's important to make one point here. When you think about the impact of climate change, there are a number of different ways that could impact banks, physical risks and transition risks associated with clients. And there are a number of different ways that you could characterize or organize those risks. There are dozens of taxonomies that are being created for different ways to categorize and think about the impact. Some, like the EU taxonomy, is what some people have called colloquially a green-brown taxonomy that seems to focus more on a certain activities contribution to climate change, and that's one very valuable perspective, a sustainability perspective. A second perspective is a risk perspective, to think about how physical and transition risks might impact certain borrowers, for example, and their willingness or ability to repay. And that's much more of a traditional risk perspective. When we're thinking about prudential perspectives, I think it's important to be clear which perspective you're taking. The Basel Committee's framework, for example, is about the risks to the financial institutions. So it's thinking about how risks might materialize to the institutions. That is distinct from a counterparty's contribution to climate change.
Thank you. And you refer to the physical and transition risk channels that through which climate risk materialize into financial stability risks. How are you thinking about the balance between the two? Because certain central banks have focused primarily on the risk angle, thinking about the physical risks, and the transition risks. There's perhaps less work done on that. How are you seeing the balance between the two in the focus of your work?
So a broad framing, one way to think about this is you can think about this channel from the climate change, from a changing climate to the economy and financial structure that has an impact on the banks. And that can be either through physical or transition risks. That's a very traditional risk management perspective. And you could take either a microprudential or a macroprudential perspective on that. That is distinct from the impact that the financial system could have on climate change through their actions, through their financed emissions, for example. And our focus is very much on the first part. How does the changing climate impact the financial system, the economy, the industrial organization of an economy, the risks that banks face? And we want to ensure that firms manage all of their risks, including those that come from a changing climate.
Thank you. And actually linked to that, there is a question about climate is just one element of thinking about the move to a more sustainable economy. And there's also developments in moving beyond climate, for example, the establishment of a TNFD, the Task Force for Nature-Related Financial Disclosures. So one question is, what is your view on nature laws, its interconnection with climate change, and the way that nature laws could amplify climate change-related risks? Is that something that the Fed intends to integrate alongside the climate risk in the work plan? The name of the committee is the Supervision Climate Committee, but is that something that's open?
So certainly there's a broader range of impacts. Some of our colleagues, for example, at the NGFS have written work on environmental risks alongside climate risk, things like pollution and biodiversity, and these are important channels also. Our work is focused on the impacts of climate change through the financial system and on the balance sheets or income statements of banks.
Okay, thank you. And just going back to regulation, the ECB is also considering climate risk in the context of the collateral requirements for central bank operations with banks. Is this something that the Fed is also looking at or likely to do in the future?
I'm not best positioned to talk about those topics. I'm focused on the supervision side and the financial risks from a microprudential perspective.
Okay. Then some more questions on the global cooperation, which is something that you did touch upon in our conversation so far. So one question is, what relationship does the Fed have with the People's Bank of China in coordinating work on functioning and harmonized international regulatory and supervisory framework for climate risk? The US and China are co-chairing the G20 Sustainable Finance Group, and both are members of the NGFS. China is leading one of the work streams at the NGFS as well and was a founding member. how are you coordinating with other central banks and China specifically?
Yeah, so we're working closely with all of these multinational or multilateral fora. I think the Basel Committee and the NGFS are two good examples where we have members from a number of different organizations working on a common topic. I think the value of that is the different perspectives that can be brought based on experiences that vary across jurisdiction, that vary across the way climate change might be materializing in those jurisdictions.
And another question also on the international implications. There are many jurisdictions heavily rely on US capital markets, but their supervisors may not necessarily match the supervision practices of the Fed. So how are you thinking, given the Fed's role as a central bank whose actions affect the global economy much more than others, supporting mid and low income jurisdictions that are highly dependent on US financial markets? Is that something that comes into your thinking at all?
Well, in our role within the Supervision Climate Committee, we're really focused on ensuring that the firms where we have supervisory responsibility are managing all the risks that they face in the best way possible. That includes risk identification, risk mitigation, risk monitoring, the steps that they're going to take in terms of governance or scenario analysis. And then that will lead to a more resilient financial system in the US that is, I think, a good outcome for everyone.
Great. And
could I pop in here with the question, since you mentioned earlier the role of the SEC, and Denai's last question got into the area of capital markets, which is more traditionally an SEC role. The SEC and the Fed obviously cooperate, and you work together in the US FSOC, the Financial Stability Oversight Council. How are you and your new tasks relating to the FSOC?
I think it's still early in terms of the FSOC and the agenda that they're going to set. So we have colleagues, I'm not directly involved, but my colleagues on the financial stability side are much more closely involved in the day-to-day interaction with the FSOC and thinking about what that agenda might be. As I mentioned, we're working closely with those colleagues in areas where there's an overlap between our microprudential responsibilities and our macroprudential responsibilities. A few of those areas of overlap are things around ensuring that we have appropriate data to do the analytical work that we need to do, developing new models that are necessary to think about some of the physical risks and transition risks, and then thinking through the pros and cons of different analytical tools such as scenario analysis and whether that would be a useful investment and a useful tool to add to our existing toolkit for either microprudential or macroprudential perspectives.
Thank you. And there's a couple of questions on the famous or maybe notorious market neutrality principle that's guiding central bank actions. And you made very clear earlier that when thinking about how you're approaching climate risk is more from a risk lens. In some central banks, they see a twofold motivation to be engaged in this agenda, protecting the financial sector from the risks, but also supporting the how and there have been some concerns with the latter that it may be overstretching central bank mandates. How do you see that in the case of the Fed in terms of your mandate and supporting green structural change beyond just protecting the financial sector from risk?
I'm sorry, Denai, you cut out a little bit in the middle of your question. So I heard the beginning and the end, but not the middle portion.
Sorry about that. It's about how do you, the twofold motivation for supporting the climate agenda. There is the risk lens, which you highlighted already, but also in some jurisdictions, the supporting of green transition policies that governments put in place. And in the case of the US, we're also seeing the green policies being a priority. But there is a concern that the latter may be overstretching central banks' mandates. How do you see that in the context of the Fed?
So our job from a supervisory perspective is clearly within our existing statutory mandate to think about and focus on the safety and soundness of the firms that we supervise, ensure their resilience so that they can continue to provide financial services. So from that perspective, the mandate issue is the guardrails around what we do. As I said, the climate change is an important issue. The Federal Reserve does not have a direct mandate to impact climate change. We have a responsibility to think about how climate change impacts our existing mandates around things like safety and soundness, financial stability, or monetary policy. And that's where we're focused. And from my particular perspective, focus clearly on the risk management perspective around the safety and soundness of individual institutions. But this is an important issue because, as you point out, other jurisdictions do have different mandates. So that's part of the dialogue that we have on a regular basis with our colleagues around the world to ensure that these multiple perspectives, the multiple mandates, are appropriately reflected in the ongoing discussions.
Yeah, absolutely. And for example, the ECB is a good case here that has a secondary mandate in terms of supporting the economic policies of the union. And that very single materiality lens that you described is also the reality for many other central banks. So it's certainly heterogeneous there. But also still on the issue of market neutrality, at the Fed, you also have the secondary market corporate credit facility. And I appreciate this is not directly within the supervision climate committee's remit, but perhaps you can tell us a little bit about the broader thinking there at the Fed. Because, for example, the ECB in its corporate sector bond program has the market neutrality principles that says that central banks buy the structure of the market sectors. That if there is a climate risk that are not priced in and that's seen as a market failure, there is perhaps a motivation to rethink that. Is that neutrality principle also guiding the Fed's corporate bond purchases and corporate credit facility? And how does the climate risks, how are these reflected into these operations?
Yeah, I'm not involved in any of the facilities, the purchase facilities, so I don't think I'm best positioned to address those questions.
Okay. Then there are some questions about the committee structure. It's a new initiative at the Fed. Could you tell us a little bit about how it's structured? So you have the two committees that you spoke about. How are the chairs working with the broader teams? How big are the committees? How are they appointed? And how do they draw from the existing Fed expertise?
Yeah, so I think from a supervision perspective, from our Supervision Climate Committee, probably the most important attribute was that this was explicitly designed to reflect insights from across the entire Federal Reserve System. So it's populated with senior staff from the reserve banks and the Board of Governors. And part of that was to support the idea that we will need heterogeneous perspectives to come up with the best insights that we can. I think, as I mentioned earlier, some of the variation in potential impact across regions and within the US is an important component of how we think about how these risks might materialize. So banks that have exposure on coastlines face different risks than banks that have exposure to certain sectors that might be facing transition risks, and they have different exposure from banks that might be in areas with greater flooding or wildfires. So all of that insight, all of that expertise that we hear, both from staff within the system, but also that we hear from the industry through our regional structure, is enormously valuable for how we think about what might be the materiality of the risks, what might be the timing of the risks, how the industry might be responding to those risks, and what might be appropriate steps going forward as we think about where things could move. We also purposely wanted to ensure that we had overlap and insights from outside of supervision. So we have folks from our research area, from our legal area, people with consumer expertise and financial stability expertise who are members of this committee to make sure that the insights that we generate are shared broadly across the different mandates. In particular, we're working very closely with the Financial Stability Climate Committee to ensure that the insights, for example, that we learn from the industry broadly defined have relevance and can be helpful as they think about their program development.
Thank you. And a last set of questions is about so-called greenwashing. And you've spoken about disclosure requirements and regulations, and there are loads of organizations that have signed up to the TCFD recommendations. They're producing climate reports, selling ESG products, but there is a concern that perhaps there is a very great push for everyone to show that they're doing something green, but it's not actually green. And when you try to bring everyone on board, there's also the question of how can we be inclusive to include also SMEs, for example, who may not have the same resources to comply to complex regulatory requirements. You mentioned that you're focusing on the bigger institutions as a priority, but how do you see that question of involving small businesses as well, who are taking these risks, and also making sure that you're not that the financial sector is not financing let's say dirty activities as opposed to green ones under these programs?
So maybe just to start at the end of your question, from our supervisory perspective, we don't have any view on what industries banks should be financing. It's a longstanding Fed position that banks make their own decisions about which legal businesses they engage with. So that is not our supervisory perspective. On your question of the disclosure and granularity, this is clearly an issue for the industry, and we hear it quite a bit. And maybe to think about it from two parts. So one is the data that financial institutions might need from their clients so that they can make their own assessments about how they want to allocate their financial services. They need good information from the clients that they serve to make those informed decisions from a risk management and from a strategic perspective. And then the second piece is, what do financial institutions do with that data? And how might they disclose to their own investors, to their own shareholders, to their own employees, the decisions that they're making from a strategic perspective within their institution? As you pointed out, many firms have voluntarily made TCFD consistent disclosures. One of the challenges that we've heard is about that input data that the institutions need to get from their clients in order to make accurate, comparable, and consistent disclosures themselves. So I think that will continue to be part of the international discussion around data gaps, around disclosure standards, and the need for consistent, comparable information on this.
Thank you. And one final question before Mark wraps this up as well, coming to a close. Climate risk management presumably means extending the horizon in which supervisors think about risks, potentially to multi-decade horizons, as well as focusing on tail risks. So what does it mean to supervise on this horizon rather than just stitching together a series of shorter periods as we move through time in the existing stress test framework, for example?
Yeah, so I think that's an excellent question, and one of the deep challenges associated with trying to understand the financial risks of climate change. I think there are a couple views on from a supervisory perspective. So one, to some extent, these physical and transition risks are already being realized. You can debate the materiality, but when we look at data, say from NOAA in the United States on the number of severe weather events, that seems to be growing over time. When we look at the potential changes from a policy perspective outside of the financial sector, more countries are instituting some sort of carbon pricing initiative. We see investors making decisions, the rapid growth in sustainability funds. These are all examples of the environment in which banks are currently operating. So the banks need to assess that, and we need to have a supervisory view on that. Second, there is the possibility that some of those risks that could occur over longer time horizons get pulled forward by market forces. The so-called Minsky moment idea, when market sentiment changes and prices change abruptly, and that could have either microprudential or macroprudential implications. And then we just need to be sure that we are doing our best to assess the full range of risks that institutions face. But this question of the time horizon is a difficult one, and one that we continue to work through.
Well, great. Our hour is pretty much up. So Denai and I, on behalf of OMFIF, would like to thank you for a first-rate, excellent, wonderful discussion today. We've had a huge audience. The questions are still streaming in, so there's obviously great interest in what you are doing. You're a busy man working on a critical task and one of mankind's greatest challenges. You have your work cut out for you. So thank you for taking time from your busy schedule to join us today. We wish you the best of luck, and hopefully we'll be able to check in on you in the future and find out how the Fed's work is evolving in this important area.
Right. Well, great. Well, thanks for having me. You're quite right that there's a lot of work to do. We're fortunate to have a great team working on it, and look forward to future conversations.
Thank you, Kevin Stiroh.